Your renewal notice just landed with a premium that's hundreds of dollars higher than last year. And here's the part that surprises people. The state government basically pre-approved that number already. Insurance rates aren't set on a whim. In most states they're filed with, and often literally approved by, your state's insurance department before a single policy goes out. So no, you can't call your insurer and just talk the base rate back down. That fight is already over, decided in a regulatory filing you never saw. But here's what almost nobody checks. The rate is one thing, your premium is another, built from dozens of rating factors specific to your house, square footage, roof age, protection class, your claims history. And those get entered by a human, which means they get entered wrong constantly. So here's the honest playbook. How state rate regulation actually works, prior approval versus file end use, how to pull your declarations page and rating basis, and audit it for errors, how to dispute a claim that isn't even yours using your clue report, when raising your deductible or reshopping with an independent agent beats fighting a market-wide increase, and when it's actually time to file a complaint with your state's insurance regulator. Before you assume you did something wrong, look at the scale of what's happening around you. The typical homeowner in America paid about 12% more for coverage in 2025 than the year before, and industry pricing models project another jump this year, pushing the national average premium past $3,000 annually. A big piece of that isn't about you at all. Insurers buy their own insurance called reinsurance to cover catastrophic years, and when hurricanes, wildfires, and hailstorms get more expensive to rebuild after, that cost gets passed straight down to your renewal. States getting hit hardest by convective storms, think hail and tornadoes across the Midwest and Great Plains, have seen some of the steepest jumps of all. None of that means your specific number can't be improved. It means you should stop assuming the whole increase is about your house, because a real chunk of it almost certainly isn't. Here's the mental model that changes everything else in this video. Your insurer did not wake up and decide your zip code deserved 8% more. In a prior approval state, that new rate had to sit in front of regulators and get an actual sign-off, sometimes with a public comment period, before it could touch your bill. In a file and use state, the insurer can start charging the new rate the day they file it, but the department can still knock it down later if it doesn't hold up. Either system means the number on your renewal already went through a government process. So when people say, "I called and negotiated my rate down," what actually happened almost never touches that base rate at all. It's something else entirely, which we're about to get into. Understanding that difference now saves you an afternoon arguing with a call center rep who has zero authority to change a state-filed number. Run your own state through this table before you spend energy on the wrong fight. California is the textbook prior approval example. Filings get logged publicly every Friday, and any consumer group can request a hearing within 45 days, though if the department just sits on it past its own deadline, the filing gets automatically approved anyway. Texas is the flip side. Insurers file under the state's file and use law and can start billing you the new rate on its effective date, though the commissioner can still later disapprove a rate that isn't backed by sound math. Notice the bottom row, because that's the actual takeaway. In a prior approval state, your rate got a government once-over already. In a file and use state, it's live right now while regulators review it in parallel. Neither version means you get a vote on the base number. Your leverage lives one level down in the next slide. So if the base rate isn't negotiable, what actually is? Everything about how that rate gets applied to your specific address. Insurers run your house through dozens of rating factors, square footage for rebuild cost, your roof's age and material, something called your protection class, which grades how far you are from a fire hydrant and fire station, and your claims history going back several years. Every one of those gets typed into a system by a human being, pulled from an old file, or estimated by an algorithm that's never actually seen your roof, which means errors are common, not rare. Let's be precise about what you're actually doing here, because overpromising gets people angry instead of effective. You are not going to call your insurer and get them to reverse a state-approved rate increase. You are going to audit the inputs that produced your number, correct what's wrong, and shop the accurate version of your house against other carriers. That's the real fight, and it works far more often than yelling at a rate does. Treat this like an actual checklist in order, because skipping straight to call and complain is where people waste their goodwill. Step 1 is slower than it sounds. Read the whole notice, not just the new total, and circle the effective date, because that's your real deadline. Step 2, call or log into your account and ask specifically for 2 things: your current declarations page and the rating worksheet that shows exactly which inputs produced your number. Not every rep knows this document by that name, so be persistent. Step 3 is where the actual savings live. Go line by line against reality. Is the square footage right? Is your roof's true age and material listed correctly? Does the protection class match your actual distance to a hydrant? And is every claim listed actually yours and correctly categorized? Step 4 branches 2 ways depending on what you found. If it's a factual error, dispute it directly with the insurer or through your clue report. If everything's accurate and the number is still high, that's your cue to reshop the corrected version of your house with an independent agent. And step 5 is the exception path, not the default one. You only go here if something looks actually improper, not simply because the number went up. Let's get concrete, because audit for errors means nothing without examples. Square footage is pulled from county assessor data more often than you'd think, and assessor records are wrong constantly. An addition that was never permitted, a garage counted as living space, a duplex mixed up with the unit next door. Roof age is usually self-reported at some point in your policy's history, and then just never updated. So a roof you replaced 3 years ago might still be rated as 15 years old, which matters because insurers price newer roofs lower. Protection class is the sleeper error. It's assigned based on your distance to a fire station and a hydrant. And if a new station opened near you, or the data's just stale, you could be paying a worse protection class rate for a genuinely better protected house. And claims errors are the nastiest because they follow you. A neighbor's claim attached to your address by a typo, an inquiry logged as an actual paid claim, or a small leak miscoded as major water damage. Any one of these alone can be worth real money once it's actually fixed. This is the highest leverage move in the whole video, and it costs you nothing. Every claim you file, and sometimes just a coverage call you made, can land in a shared database called Clue, which every insurer pulls before quoting you a rate. Because it functions like a credit report for your house, federal law treats it exactly like one. You're entitled to your own free copy once a year, and if an entry is wrong, someone else's claim, a duplicate, something miscoded as bigger than it was, you have a legal right to dispute it, and the company has to actually investigate at no charge to you. Here's why this matters even beyond your current insurer. A bad Clue entry doesn't just inflate this year's renewal, it follows you to every carrier you try to reshop with next, quietly tanking every quote before you even see it. Pull it before you do anything else on this list, because it changes what the truth about your house actually is. 2 moves here, and they work together. An independent agent isn't loyal to one company's rate table. They can run your corrected profile against a dozen carriers in a single afternoon, including regional insurers that don't advertise or sell direct at all. And regional carriers are sometimes dramatically cheaper in exactly the markets big national brands are pulling out of. The second move is one you control completely without shopping anywhere: raising your deductible. Moving from a $500 or $1,000 deductible up to $2,500 or higher tells the insurer you're absorbing more of the small, routine claims yourself, and that can shave a real percentage off your annual premium. The catch, and it's a genuine one: only do this with money you could actually produce the week after a pipe bursts or a tree comes down. A cheaper premium you can't afford to activate isn't a discount. It's a trap you set for your future self. This one's easy to skip because it sounds like a sales pitch, but in some states it's actually the law, not a courtesy. Florida is the clean example. State statute requires every property insurer to give you a documented discount for verified wind-resistant features. A hip-shaped roof, hurricane straps connecting your roof to your walls, a properly sealed roof deck, impact-rated windows or shutters. A licensed inspector documents it on one standardized form that every Florida insurer has to accept, and that report stays valid for 5 years. So it's not a one-time favor, it's a durable rate reduction. Even outside Florida, most insurers offer some version of a roof or storm hardening credit, plus the oldest trick that never stops working, bundling your home and auto policy with the same company. None of these fix a market-wide increase, but stacked together they can claw back a meaningful chunk of it. And unlike disputing an error, you don't need anything to be wrong first, you just have to ask. Run your own increase down this table honestly, because confusing the two columns is how people waste months. The left column is where you have real, factual ground to stand on. The insurer has your square footage wrong. Your roof's actual age isn't what's on file, or there's a claim attached to your address that was never yours. Fix the input, and the number that comes back out is different, sometimes substantially. The right column is where most of this year's increases actually live. Your carrier's reinsurance got more expensive, or your whole state or region got repriced after a bad storm season, and every accurate policyholder in that pool got some version of the same letter. That's not a mistake to dispute, and no phone call fixes it. What does work is the honest move from a few slides ago. Take your accurate profile to an independent agent and let a different carrier, with different reinsurance exposure, quote you their number instead. You're not overturning anyone's math, you're finding a carrier whose math currently favors you more. Two separate tools live at your state's Department of Insurance website, and most homeowners never open either one. The first is a rate filing lookup. Texas, for instance, lets you search by company name to see filings, and from there you can pull the full technical filing through a shared national system called SCRFF if you want to see exactly what data justify the increase. Not light reading, but it exists, and it's public. The second tool is the complaint portal, and it's free to use, no lawyer, no fee. But be precise about what it's for. A DOI complaint isn't a button that reverses your rate. It's a review of whether the insurer actually followed the rules it filed. Did they apply the correct rating factors? Did the notice meet the state's requirements? Was something about the process itself improper? File a complaint when something looks broken, not simply because the number went up. Regulators can't override a properly filed, properly approved rate just because you don't like it, but they absolutely can catch and correct one that wasn't handled by the book. So here's what to actually do this week. First, let go of the idea that you can talk your carrier down off a state-filed number. In a prior approval state, it already went through regulators, and in a file-end-use state, it's live under their ongoing review, but either way, it's not a haggling conversation. Second, get your declarations page and rating basis and go through it like an auditor, because square footage, roof age, protection class, and claims history are entered by humans and wrong more often than anyone admits. Third, pull your clue report, free, federally protected, and worth disputing if anything on it isn't actually yours. Fourth, once your profile is accurate, that's when you raise your deductible, ask about every discount you might qualify for, and let an independent agent requote you elsewhere instead of assuming your current carrier is the only option. And only reach for a DOI complaint when something about the process itself looks improper. That's the tool for catching a broken rule, not for undoing a rate the state already approved. This video is general education, not legal, financial, or insurance advice, and the rate filing systems, rating factors, discount programs, and complaint processes covered here vary by your state and by the specific terms of your own policy. It was researched and produced with AI assistance, including script research, voice, and on-screen graphics, and reviewed by a human against the cited sources before publishing. Before you act, request your own declarations page and rating basis, pull your clue report, and check your state Department of Insurance's rate filing and complaint tools directly. And if you suspect discrimination, a filing irregularity, or you're facing a lapse in coverage, talk to a licensed insurance professional or attorney in your state. Subscribe. Homeowner Rights Explained breaks down one homeowner right every video.